So good afternoon, everyone. Good morning for those who are in Switzerland. I would like to welcome you to today's webinar about sustainable finance trends in Switzerland and Hong Kong 2020 and beyond. I'm Katia Stampli-Ferraz. I'm the Deputy Consul General of Switzerland and Hong Kong, and I'm very excited about today's webinar, which there are over 270 people who sign up for this webinar, especially from Switzerland and from Hong Kong, but we saw there are people a bit from all around the world, and we are very excited about that. To begin with, a few technical information. All the participants except the speakers are on mute and with no video. We have a chat function that you can use for your question. We are very much looking forward to your questions, so please do use it. Also, you can, if you see other question that you particularly like, you can give a thumbs up to the question and we can also have a look at that. The question will be answered at the end of the webinar. It is possible that not all questions will be answered just due to time constraints, but feel free to reach out to us also after the webinar, and we are happy to answer your question also later on. And although nowadays we have to do many things online, we hope maybe to have also an exchange later on. Okay. So I just mentioned, I'm Katia Stampli, Deputy Consul General of the Consulate General of Switzerland and Hong Kong. I'm speaking from Hong Kong right now. And this webinar is a collaboration with the Swiss Consulate in Hong Kong and then Swiss Sustainable Finance based in Zurich and a Sustainable Finance Initiative. So we have really the two worlds connected. But why the Swiss Consulate has interest in facilitating such webinar? Why do we have interest in talking about sustainable finance? Well, we really think with Consulate, but Switzerland as country, we think that sustainable finance is a very important topic and it's close to our hearts. We as society did already a lot in order to reach more sustainability around the world, but the path is still very long and there are still many barriers to overcome. As we all know, Switzerland is an important financial player, and we are proud that also sustainability it's a very important topic for our country. Building a sustainable society is key for the future of everyone. And one of the ways to reach this goal, to have a more sustainable world, and especially also in finance, of course, we need to invest also in education and training. So we hope that today's webinar will be a fruitful exchange of information for all of us. But let me now introduce you the speakers and to go through the program of today. We will first have Sabine Döbeli, CEO of Swiss Sustainable Finance, who will talk from Zurich, and she will give us an overview on Swiss sustainable investment market and regulatory development in Switzerland. Then from Zurich, we will go back to Hong Kong, where Leonie Kelly, partner of Sustainable Finance Initiative, will talk about investor perspective in Asia and the latest policy developments in Hong Kong. And at the end, around 4:40 p.m. in Hong Kong, at 10:40 a.m. in Switzerland, we will have our Q&A session. But without any further ado, I will give the word to Sabine and enjoy the webinar.
Thank you, Katia, for these introductory words. And I would like to also welcome you from the side of Swiss Sustainable Finance to this joint webinar with the Swiss Consulate in Hong Kong and with the Sustainable Finance Initiative. We're very pleased to build this bridge today and learn from each other. And actually, when I look back 3 years ago, I visited Hong Kong and met Leonie Kelly for the first time when they just set up their initiative. We shared first experiences And I'm very glad that now, 3 years later, we can both look back on a further path in sustainable finance and hopefully illustrate during this webinar how sustainable finance has evolved in the two regions, both in Hong Kong and in Switzerland. For those of you that don't know Swiss Sustainable Finance, I'd like to briefly give you an introduction into the activities of our association. Actually, our vision is to make Switzerland a leading voice and actor in sustainable finance, with the clear goal that the financial sector contributes to a sustainable and prosperous economy. How do we aim to achieve it? We have three main activities: shaping and informing on best practice, mainly through publications and events; creating supportive frameworks and tools. We have different work groups in place that prepare useful tools for our members; and last but not least, cooperation both with our members and other partners in the Swiss network to really make Switzerland a leading center in this field. These are our three main areas of activities. If you look at our member space, I think what makes us quite special is that we are not just a financial industry association. We have members across the range of banks and asset managers, pension funds and other asset owners, insurance companies, service providers, all the way to network partners from research and education facilities. And we also have other NGOs and public sector entities on board. Our members range from very large organizations such as UBS or Credit Suisse to smaller asset managers like Robeco Sam. We have the largest pension funds of Switzerland with BVK, many of the large insurance companies, and then I mentioned the universities and mainly other finance associations such as the Swiss Insurance Association or the Swiss Funds and Asset Management Association, to name just a few. So with this very broad network, I think we're well positioned to also try and build bridges between different types of players in sustainable finance. For example, we have one work group that takes into account the needs of asset owners for transparency on the sustainability of portfolios. And we also debate this with the asset manager members to make sure that what they publish is useful for the asset owners as well. This is just one example of a topical work group. Now, one of our key products is an annual market study on sustainable investments in Switzerland. And I would like to highlight a few of the results of the last market study that we published in June this year. And first of all, you will see an impressive market growth when it comes to sustainable investments in Switzerland. Actually, the volumes grew to 1,163 billion Swiss francs of assets managed with one or more sustainability approaches. Compared to the previous year, this was an increase of 62% from last year, which we do think is quite impressive. The strongest growth this year clearly came from asset managers and banks, with funds seeing an increase of 147% and mandates even a plus of 195%. There are different reasons for this impressive growth. First of all, we did see a wider adoption of sustainability, of ESG approaches to existing assets. So not all of this is, of course, inflows into sustainability funds. It's really also asset managers adopting ESG strategies to already existing funds. That was one factor. Another factor is actually inflows into sustainability funds. And the third factor was also a performance effect of roughly 18 percentage points if you calculate this on the asset basis of the previous year. So three main drivers for this growth. Now, if we look at the market share of sustainable investments, it has grown to considerable shares, especially for funds, where nowadays around 38% of all funds apply one or more sustainability approach. These are funds managed in Switzerland. It's similar for the assets of Swiss asset owners, namely pension funds, insurance companies, and foundations. Roughly 30% of their total assets already apply sustainability approaches. If you calculate this share for the total market, so for all funds, mandates, and asset owner, we estimate that roughly 1/3 of all assets managed in Switzerland already take sustainability factors into account. Now, you may ask yourself, if we talk about 1/3 of the market, how sustainable can this really be? Now, I'd like to give you some more insights on the different approaches applied to the sustainable investments. We differentiate between 8 different ways of how you can actually integrate sustainability into an investment process. That ranges from ESG integration, where you integrate such factors with a financial view to actually improve your risk-return profile. It can be via exclusions. It can be via active ownership strategies such as ESG engagement or voting. Norms-based screening is one of the approaches we count. And then we have the more specific approaches such as best in class, where you focus on quite sustainable companies within a sector, and then also thematic approaches or even impact investing, where you try to demonstrate a real-world impact. What was surprising to us is that we saw considerable growth across all these different approaches, many of which are, by the way, combined. But something really jumped into our eye. We saw the strongest growth in 3 approaches which have a more outcome-oriented approach. That was namely ESG engagement, ESG voting, and impact investing. These 3 strategies showed the highest growth rate. And frankly, for us, this is a sign that we are somehow moving into a 3rd phase of sustainable investing in Switzerland. It all started with exclusions, maybe some best-in-class approaches as well, so more aligning investments to values. It then moved on to ESG integration, where the financial focus was in the center. And now what we clearly see is that investors aim to have a real-world impact. This is why they increasingly follow such approaches, where you also enter into a dialogue with companies and try to improve their sustainability strategies, or an increasing number of asset managers offer products that have a real impact focus. One thing we were interested in and that we've looked into for the first time this year was the actual combination of different approaches. For the first time, we calculated what kind of shares of the total volume apply how many different approaches. And what we found is that above 80% of the total volume applies 2 or more approaches. It was only 17% of the total volume that focuses on just one approach. So in a way, this gives us some insights with regards to the sophistication of these sustainable investment approaches. And if we look a bit deeper, we actually see on the next slide, here you see the different combinations, the top 5 combinations of the total volumes. What we did here is we used 2-letter acronyms for each of the approaches and demonstrated which combinations are applied most frequently. So by far the highest volume we found for a combination of exclusions and integration. And then the second highest position also added norms-based screening plus engagement. So here, for the second highest volume, you already see that many different approaches are combined. Approaches that select stocks or bonds based on sustainability criteria, but also aim to have an influence on the companies. In the 3rd position, we purely find one approach, namely ESG integration. This is for a total volume of 113 billion. So you could say roughly 10% of the total assets that we found in our survey purely focus on this financial perspective of ESG integration. You may challenge if these are truly sustainable investments, as they really have the finance focus, but nevertheless, we only talk about 10% of total investments. And then this is followed by a combination of exclusions, engagement and integration, and also engagement and voting. So clearly a broad variety. What we do not see represented in the top 5 are the more narrow approaches such as thematic investing or impact investing. But it's also in the nature of these approaches that they are more satellite solutions and wouldn't account for the very high volumes. So much about the combinations. We also wanted to know from our survey participants what were the main drivers and barriers from their point of view for further growth in sustainable investing. And let me summarize it as follows. For asset managers, this year, clearly client demand and legislative pressure were the 2 drivers that were seen as most prominent. I think especially client demand is interesting to see. So obviously banks increasingly are challenged by their clients to offer sustainable investment solutions. I think this also demonstrates the necessity to make sure that the employees vis-a-vis clients, so client advisors, are educated well on sustainable investments. It also demonstrates a need for further education in this field. And the fact that legislative pressure is growing can be, of course, underlined by the many developments we see in Europe. I will also touch on it later. The key barriers on the side of asset managers were lack of standards. This is definitely something that we as an industry association also have to acknowledge, that the industry calls for clearer standards as to what can be considered sustainable, what the different approaches really mean, and when you can claim to have a certain approach applied. I think initiatives such as the recently published CFA ESG standards, the draft standards, can clearly be seen as a reaction to such concerns. And I think we can only profit from it if we find also a global alignment on terminologies with regards to sustainable investments. When we look at asset owners, the main pressure that they feel comes from board and also from the political side. If we think that in Switzerland it's actually not mandatory for asset owners neither to report on sustainability nor to actually take into account sustainability criteria, it was a bit surprising for us to see the political pressure so prominent. But also we saw a lot of political interventions in our parliament recently, and obviously this left its trace also in board discussions, in pension fund board discussions, for example. The key drivers for asset owners still seem to be on the financial side. The main concerns were around performance, something that came as a bit as a surprise to us, because we all know, and especially in the phase of COVID-19, the COVID-19 crisis in spring, we saw that sustainable investments actually demonstrated quite a strong performance. So performance concerns to us no longer seem the main issue, but in the view of asset owners, this is still the case. Clearly so, they also fear higher costs, something that can be understood against the backdrop that many of Swiss asset owners shifted into low-cost passive solutions. So whenever you choose an active, sustainable solution, you will find higher costs with it, of course, by nature. Nevertheless, we hope that asset managers also see and hear this and also make their sustainable investments competitive cost-wise. If we ask them if they still expect further growth, actually both asset managers and asset owners are still very positive and expect a growth of either between 1 to 15% per year or even 15 to 30% per year. So further strong growth expected, even though we already have high shares of sustainable investments in Switzerland. So definitely this is a positive outlook for the whole sustainable investment sphere. Now, I would like to lose a few words on regulatory developments, and I start with a quote from Federal Councillor Simonetta Sommaruga, who is actually the Swiss president this year. This quote stems from a discussion last autumn in the Swiss Council of States, where she said, Swiss investors must have an investment behavior that ultimately does not torpedo our measures to achieve the Paris Agreement. So a clear call from the government that the financial sector also has to contribute its share to achieving, on the one hand, the Paris Agreement, but in other contexts also contribute to the SDGs. This is the view of the Swiss government. Yet the way they address it, and you can see this on the next slide, is mainly so far with a voluntary approach. The Swiss government is, and the Swiss authorities are increasing the pressure on the financial sector. But if we look at the report that was published by the government in June this year, where they did a bit of an outline of the different possible measures of the way they could potentially address it, the main conclusion was always that they see the main responsibility with the market players. They expect industry associations to become active, to, for example, create standards for certain product segments, to become more transparent. And so far, they do not aim for mandatory approaches. The Federal Council set up different working groups to dig a bit deeper into topics such as fiduciary duty, transparency, but also climate risk assessment. Swiss Sustainable Finance was represented in one of these working groups that also came with concrete recommendations. And based on these recommendations, we expect the federal government to come up with more suggestions by the end of this year. One thing that I would like to highlight is that Switzerland has already offered to market participants to screen their portfolios with regards to 2-degree alignment or even 1.5-degree alignment through the so-called PACTA tests. In the last round that was offered 3 years ago to asset owners only, it was really limited to insurance companies and pension funds. And this year it was also banks that were invited to screen their portfolios and their lending portfolios actually. And for the first time, the Swiss Federal Office for the Environment, which organized these tests, also offered a module on real estate investments, as real estate investments are, of course, seen as an important level to also bring down Swiss CO2 emissions. As in many other countries, real estate accounts for roughly 1/3 to 1/4 of total emissions here in Switzerland. A new development we have seen with the Swiss regulator FINMA, the supervisor of banks and insurance companies. FINMA is currently examining mandatory transparency on climate risks for large financial corporations. We will see if they will go forward with this idea, but this is something that FINMA announced over the summer. A few comments on other market developments in Switzerland on the next slide. Or first, I should say regulatory developments, because since last Friday, our our parliament has actually passed the CO2 Act. The CO2 Act in Switzerland has a long history. It was declined last December and now over the course of this year was again reworked. And now we have a CO2 Act that was passed by both chambers. Article 1 the overarching article of this legislation stresses the importance of aligning financial flows to the Paris Agreement. So it makes the clear link to the Paris Agreement that also has this kind of wording in it. And then we have an additional article 47A that obliges both the Swiss National Bank and the regulator FINMA to assess climate risks. These are the two ways in which the financial sector is reflected in this new CO2 law. But of course, we will have to see how this is then turned into concrete obligations on different levels. This is something that will happen in a second step. At the same time, we see a lot of voluntary initiatives from different industry associations. We have jointly with Swiss Funds and Asset Management Association published recommendations on sustainable asset management in June this year. You find them online, and we just described the different needs to integrate ESG across the different elements of an asset management process. Swiss Banking presented recommendations on the client advisory process. How can you actually integrate ESG factors into the client interaction? That was a paper also published in June. And for the Swiss Insurance Association, they, for the first time, came up with a sustainability reporting for the whole industry and demonstrated activities both on the underwriting side, but also on the asset management side. So these are the more voluntary initiatives that we see happening in Switzerland. And with this, I actually come to an end. I'm sure we will have time to dig a bit deeper in the course of the Q&A session. But now I would like to hand over to Leonie Kelly for her to provide us an insight on what's happening in Hong Kong. Thank you for your attention.
Thank you, Sabine. So to follow on, really moving and zooming into Hong Kong now, and very much thankful to the Swiss Consulate and also Swiss Sustainable Finance for putting together this webinar today and to invite Sustainable Finance Initiative. So in terms of who we are, so Sustainable Finance Initiative, if we move to the next slide, please, is a Hong Kong-based investor network of private investors, really with the mission to unlock private capital and allocate that towards sustainable finance. Our vision is to make sustainability synonymous with finance. And as Sabine mentioned earlier in the call today, it was around 3-4 years ago that we sat down with Sabine to really understand how Swiss sustainable finance has managed to influence, educate, and propel the market forward in Switzerland and broader Europe and internationally, to understand how an outfit like Sustainable Finance Initiative Hong Kong may have an influence in helping inform and grow investor appetite here in Asia. So our mission is centralized around 4 key pillars of work, as you can see here. So we work primarily across 4 categories: people, policy, practice, and product. And these categories have been identified on the back of a specific piece of research that we issued back in 2017 to the market called Mapping the State of Play of Sustainable Finance in Hong Kong, where we were really trying to understand what is the market sentiment towards sustainable finance in Hong Kong, what have been the barriers to growth, and importantly, what could be the levers moving forward. And we identified these 4 areas as ecosystem gaps within which, if we as an initiative were to focus, we believe we could help propel the market and move things forward. So under our people pillar, we work primarily with private investors, wealth owners, high net worth individuals, to create and inspire and bring together individuals to think about sustainable finance, and also supporting and nurturing talent in the industry, which we believe to be a significant gap in the Asian market today in terms of ESG expertise. We work across policy and trying to amplify our investor voice as a high net worth collective group of individuals, really trying to help regulators, policymakers understand, what it is we believe may be the, technical approaches to inform and influence policy that would promote the growth of sustainable finance in Asia. And on the back of that, we've worked with the HKMA, the Hong Kong Exchange, the Securities and Futures Commission to sit down, interview and understand what is their strategy for green and/or sustainable finance in Hong Kong. We also work across practice and product, really trying to instill rigor within which we believe is impact investing and sustainable finance strategies of the future. So we work with fund managers and institutions to try and understand what is best practice today and how can we influence to instill that rigor, bearing in mind we come from the investor perspective and showcasing what we believe should products be integrating today in terms of ESG and impact. SFI also has a mission to help educate, grow and connect the broader community of not just investors, but other key stakeholders in the market. And we do have a free resource, a knowledge bank that we have created that works across our 4 pillars, helping showcase the developments across policy and practice in Asia and the increased product flow that we're seeing in the market. Next slide, please. So how do we view sustainable finance? And I think this is an important perspective just to highlight before we jump into the rest of the material for SFI. When we started out, back in 2017, we really wanted to understand where is the market in terms of sentiment towards sustainable finance and what is the market definition of this in Asia. Because what we found is it's a very much growing topic in Asia, but yet we haven't centralized around one key definition, and perhaps nor should we, but we wanted to understand what is the market understanding of sustainable investing. And I think Sabine will be glad to know we've taken something that's very much in sync with the Swiss sustainable finance, because we do believe it's important to have continuity and variability in the market across how we define sustainable or sustainable finance. So on the bottom, you can see we primarily work in the green spectrum of sustainable investing. And for us at the Sustainable Finance Initiative, we see sustainable finance really as an umbrella term that sits across the investment spectrum of different strategies that one could apply to integrate environmental, social, and/or governance criteria into the investment decisions or business decisions. Really for the longer term benefit of society and investors. And we look across the spectrum of different strategies that Sabine kindly brought us through earlier, ranging from exclusionary to ESG integration, engagement to thematic and impact investing. So as a collective group of investors, we look across the spectrum of impact and sustainable investing strategies equally, and we look across thematic within these issue areas as well. Next slide, please. So just to think about what has been the growth in sustainable finance in Hong Kong. If we look at some of these statistics today, we can see very much that global sustainable investment, as Sabine mentioned, has really grown in the past decade or so. But Asia has been somewhat falling behind. So these are statistics according to the Global Sustainable Investment Alliance as of 2016. They may have been updated since, but back in 2016, what we were looking at is that Asia accounted for only 0.2% of global sustainable investment assets. Now that's something that we need to change, and certainly something that we have seen develop significantly since the release of this data back in 2016 to where we are today in 2020. Next slide, please. So the report I mentioned earlier, we used as a way to try and identify the market sentiment back in 2017. So looking at these statistics that were coming through from the likes of the Global Sustainable Investment Alliance and being active in the industry, we knew there was a gap. We knew that, yes, Asia was lagging behind back then, but what would be the strategy to propel us forward? Next slide, please. So what we did was engage the market in a quite a rigorous, I would say, survey and interview process that went out not only to asset owners, but asset managers, financial institutions, policymakers, regulators, research, academia, intermediaries, everybody that really had a role to play in transitioning the Hong Kong ecosystem to being a sustainable finance hub. And what we found back in 2017 at the end of this research period was, yes, the market did agree that, over 90% actually of participants who worked with us in this research agreed that, yes, Hong Kong is behind and reactive within the industry of sustainable finance compared to our global peers in other financial districts around the world. And what we also learned that there was an increasing appetite to become active, either as asset owners, asset managers, policymakers, to help transition Hong Kong and broader Asia to being that hub for sustainable finance where we could. And importantly, I think it was a recognized trend that we would have to become a sustainable finance hub for the ongoing financial sustainability of the Hong Kong industry as well. And I think that was an important finding, not only that SFI made, but that was being made by policymakers and regulators locally as well. Other facts interesting enough to us was that, when we split the participants by gender, what we were finding is that, over 60% of our female respondents perceived sustainable finance as very important or highly important. And I think that's a trend in the market, but it's also a trend that we found important because we want to pick up and help grow the ESG talent, specifically in this industry too. Next slide, please. So the key findings back then in 2017 that if we were to maintain our status as an international financial hub, was that Hong Kong would have to catch up, move from the laggard position and move ahead with setting progressive policy structures, enabling asset managers, asset owners to think about ESG integration, and also creating the bed of talent to promote ESG expertise in Asia and in the industry. But that did not come without challenges. I think what we found back then in 2017, nearly 25% of our respondents were saying, we need to increase market awareness and understanding and education and really help unlock the perceived barrier that to become active in ESG or sustainable investing, one would forgo financial performance. And that was something that we definitely came across back in 2016, 2017. So that perceived belief that there is a concessionary financial return and activity in ESG would stifle growth was certainly a perspective back then in 2016, 17. But we did see these challenges as a room for growth and opportunity. And I think what we have found since then is the growing change in perspective, not only from investors, asset owners and private wealth individuals, but also from the broader community. The growing ESG and sustainable investing landscape here has certainly propelled since 2016. And I think, one of the key challenges that we found in 2016 was that we would need more supportive policy environment to help really incubate, incentivize, and promote the market here, and to help move the industry forward. Next slide, please. So this brought us to, once we had conducted this survey, to thinking about how can we influence the private investor group, which is very much where we're focused, to think about how can they allocate their capital for impact and or sustainable investments. And we wanted to help grow our community of wealth owners in Hong Kong. Because we felt also, if you look at the economic segmentation of Hong Kong, 33% of Hong Kong's AUM is held within private capital or private wealth. So for us as the Sustainable Finance Initiative, we did see it as key and instrumental that if we could help influence even a tiny proportion of this, we would hope we can move from that 0.2%, which we discussed earlier in terms of assets being allocated to ESG and impact. And we conducted this survey actually in 2019 with our community and I say our community, who are family offices and individuals based out of Hong Kong, Taiwan, and Singapore, who are investors that are active already in sustainable finance and looking to become more active. And we engage them to try and understand, what are the perceived barriers to growth in terms of, is it product supply? Is it, more supportive services around, more hands-on advice around ESG integration and conducting impact due diligence that may be inhibiting you as a wealth owner from allocating capital towards sustainable finance strategies. And we also wanted to understand, what is the investor sentiment towards thematic? Is it aligned with the Sustainable Development Goals, or is there any issue-specific areas for our Asian group of investors that stand out and that we should be focused on to help inform these investors and future products in the market? If we move to the next slide, please. So what we found when we engaged our collective group of investors was that the primary three reasons for becoming active in sustainable finance was really coming from a perspective of, well, I want to contribute to sustainability. I want to solve issues and challenges. And this was the primary goal and intention, at least of our private investor group. It was seen as an alternative to philanthropy and as a way to maximize impact, which is very important. Traditionally, we would say sometimes there's a siloed approach to philanthropy and investment. And what we were finding now in 2019 is that recognition that, hang on, sustainable finance is an alternative to philanthropy. We can be strategic with our capital, how we allocate it across our portfolio and asset class and across thematics. And importantly, a key factor that we did find, over 30%, which you can see here, we're looking at sustainable investing as a way really to engage with their next generation. And that's something that is not just Hong Kong specific. I believe that's global as well, in terms of the number of surveys, data, research reports coming out of around from banks, private banks, institutions, all supporting the fact that millennials, next gen, they are demanding different ways to manage capital and to do that with a conscience. And I think that's something that our data back in 2019 certainly aligned with. Also, one of the key drivers is around portfolio diversification. And interesting to us, in 2019, this was being seen as a financial opportunity, which was one of those aha moments. We had moved from 2016 and seeing this as a very much a concern to us that, if it is still perceived to be, your foregoing financial return, to now something that's now being seen as an opportunity. We've really shifted in quite a short space of time. And also to identify this as a way to manage risk and a better risk management strategy for investors. So from all this, what we could say was that our investors had grown in awareness. There was a broader understanding that sustainable finance can mean you can balance your risk, return, and impact profile. And it is a means to engage with next generation within families. Next slide, please. In terms of what was their specific thematic issue area, I think what we found is overall probably thematically agnostic and also geographically agnostic. But if we were to zoom in on maybe the top 3 SDGs that were selected by our investors or category preferences, they were around goal 3, 4, and 13, which are, as you know, good health and well-being, quality education, and climate action. But I think even what we found since 2019 in issuing this survey is that attitudes have certainly changed, given the pandemic experience, and certainly in conversations that we've had and the team have had, is that recognizing we're not just focused on one specific SDG goal. In fact, all of these goals we see on the screen are interconnected, and we need to think interconnected investment opportunities as well as we take decisions in where we place our capital. But I think this is something that during the pandemic has helped redefine really focuses for investors and institutions delivering products in the market. Next slide, please. So I mentioned earlier, we do have an active bank of insights and knowledge. As a not-for-profit, this is our goal also to raise awareness and education, and we submit various policy articles with our partners, including the Exchange, the Hong Kong Monetary Authority, and the Securities and Future Commission, to name a few. So this is a resource base that I just wanted to highlight for everybody on the phone call today. You can tap into and zoom into some of the thought where that we have developed as an initiative and perspectives from our investor community. On the bottom right, you can see what we have is the people pillar, which I discussed earlier. We have a number of investor engagements where we sit down and discuss with our investor sponsors what has been their journey into sustainable finance, what is their impact, risk, and return profile, and how they are engaging the next gen and their banks for change. And we also then have various podcasts and articles that we release across practice and product. Next slide, please. So at this point, I wanted to just zoom in a little bit on what have been the key policy recommendations. And I haven't put this on a slide because it would be nice to also engage maybe in the Q&A from you if you have specific questions into what's happening in Hong Kong. But Sabine has kindly brought us through the Swiss development activities in policy and what has been the shift in market there. When we think about Hong Kong, I think the transition that you have seen, even in some of the data that I've discussed from 2016 to 2019 in our research, is that investor demands have changed, and there has been certainly an uptake of ESG in the market. And I think what I'm trying to say is that the center of gravity has shifted rapidly in Asia towards ESG. We've moved from it being a position of ESG as reactionary to understanding that ESG can be integrated and we can be constructive about ESG for our risk management processes, but it can also add value. And I think from a policy perspective specifically, if you were to ask what are the regulation changes that have happened here, there's a few key areas maybe that I can highlight that might be useful for those in the call. First is what have been the policy or regulatory changes for asset owners. So the Hong Kong Monetary Authority, so HKMA as the manager of the exchange fund, back in May 2019 announced its responsible investment measures. And this was significant because what they announced to do was very much to incorporate ESG factors into its credit risk analysis of the bond investment market. And since then to have invested 1 billion each in managed co-lending portfolio programs run by the IFC as well. So this is part of their commitment as a manager of the exchange fund to do this. And in addition, the third key commitment that they were making was to further grow the exchange fund's green bond portfolio and to also participate in ESG-themed public equity investments through external managers in the industry, both across active and passive strategies, but targeting a specific ESG benchmark index. So this was a significant development. It was also a significant development back in 2019 to see the Hong Kong Monetary Authority actually become a signatory of the Principles for Responsible Investment and a supporter of the climate-related financial disclosures. So that was really an uptake by a significant asset owner to scale up ESG requirements for external managers. In terms of asset manager change and shift, what we've seen is a significant uptake by the Securities and Future Commission to strengthen the emphasis on ESG through upgrading their principles for responsible ownership, but also issuing their strategic framework for green finance back in 2018. So what did that strategic framework for green finance mean for Hong Kong? Well, basically what it meant was it was a strategy for the SFC and their commitments to kind of overhauling the regulatory regime with global standards and aligning to those. What they were setting out in that strategy was really setting the expectations of the asset management firms in Hong Kong in areas such as governance and oversight, investment management, risk management, and disclosures, be that environmental and or social or specifically climatic. The strategy is looking to provide guidance and best practice standards, but also training, which is key in supporting the growth in the industry uptake and integration into asset managers.
Leonie, thank you very much.
Sorry.
If I can maybe interrupt you to wrap up very quickly, otherwise we will not have enough time for the very interesting questions that are popping up.
Okay.
Do you want to wrap up just briefly?
Sure.
Or you are done?
No. I can wrap up briefly. So I suppose just to the primary developments then we've seen are on behalf of asset owners, asset managers, and also significant updates from the Hong Kong Exchange, which we can share articles to highlight to those on the phone call. But happy to take questions now from the audience.
Great. Thank you very much, Sabine and Leonie. Very interesting presentation. We have a series of questions coming up. I would like just to remind everyone that this webinar has been recorded and you can find it and look at it also later on the YouTube channel of Swiss Sustainable Finance. So in case you have to run out, you can always go back to the webinar also if you want to see more further details. So going to the question, the first question is for Sabine. They say Doris Albiser asks, thank you for your insights. How do you perceive the trends in impact investing for the NGO space?
Well, thank you for this question. Actually, we do see NGOs becoming more interested in sustainable investing as a tool for two things. On the one hand, to invest their own funds, but I have to admit in Switzerland, there are not too many NGOs that already have a sustainable investment strategy. Many of them maybe don't have a long enough investment horizon, but we do see some NGOs with a sustainable investment strategy. On the other hand, we do see organizations that start to use the tool to also actually fund projects. I'm talking of outcome-based payment approaches, where you actually also have a role as a donor for a project, but you only donate money if you see an outcome that you previously agreed upon. So these are definitely two ways of how NGOs can use sustainable investing, but I also see room for more in this space, especially when it comes to blended finance solutions. And there are discussions in Switzerland about promoting further cooperation also between NGOs and investors to foster impact investing. I leave it there.
Okay, thank you very much, Sabine. Then we have another question that has been also liked by more person, by Nadine Berchtal. Maybe Leonie, you could start this time. How could new technology, but also current technology, help to boost sustainable finance?
Sure. No technology expert, I will say, but I believe what we're seeing today is the very much uptake of, how can we use technology for good, certainly with ESG data collection and ratings, which has been one of the key, I would say, inhibitors insofar as, we're looking for methods and strategies to scrape publicly released information on ESG data, but yet we need the technology solutions to move us faster. And I think that's where we're seeing significant tech developments with the systems and infrastructure around that to support greater transparency with technology. There's also another question there that I would like to answer if I have time, Katia.
Go on.
I won't go over time, I promise. So it's from Pius. So your question, Pius, is in relation to ESG and reporting and the change in requirements for companies listed on the exchange, and what does this all mean? What have been the reaction of companies, and is it more a must or an opportunity? I would say in short, how we are seeing this is that it is a must and it is an opportunity. If must, by that you mean mandatory, what I would say is that the Hong Kong Exchange which, as you know, they introduced mandatory disclosure requirements to include a board statement setting out board consideration of ESG matters, and also the application of reporting principles. So by that we mean materiality, quantitative and consistency metrics, and also under the mandatory disclosure requirements, listed companies having to release an explanation of their reporting boundaries used within their ESG reports. There were a few other significant developments within the Hong Kong Exchange ESG disclosure changes that did happen. And it requires disclosure of significant climate-related issues which have impacted or may impact the issuer. They also updated the environmental metrics to require disclosure of relevant targets, and also upgraded this disclosure obligation of social KPIs to comply or explain, which was a significant development within these recent set of changes. So those are the key changes that we've seen. And I think the market sentiment has certainly, we hope, seen this as an opportunity to, improve their ESG management processes. Viewing this certainly from a risk management perspective, I think in terms of attitude, what we've seen is a shift away from the reporting mentality to one of management. So shifting the conversation to the boardroom, into developing integrated strategies within companies, versus this just being an output at year end, whereby I tick, a number of metrics and report those. It's moving from that tick the box to a management process. So I think that's where we've seen the opportunity happen in Hong Kong, and certainly this piece of ESG updates has helped move the market forward.
Perfect, thank you very much, Leonie. Another question this time for Sabine from Caroline Santos. Also say thank you, both speakers, for the great information. The concern of asset owners to have lower financial performance when they invest sustainably seems to be recurrent, even with some facts showing otherwise, like what happened during the peak of COVID. Any thought about why this concern is always around, and what can be done to make it go away?
That's a very good question, and a question that we pose ourselves again and again. I think it is difficult to have this prejudice also disappearing. We think it can only be addressed through real-world examples. Academic studies don't seem to be enough. There are lots of academic studies out there demonstrating that you don't lose out on performance. But what asset owners need to see is that their peers actually have just good experience with sustainable investment and do not have an underperformance. We have one investment foundation in Switzerland focused on pension fund investments that has consistently been in the first quartile regarding performance over the past 10 years probably, and they are very strict in their sustainable investment approach. This is an organization that I like to quote to also address such concerns.
Thank you, Sabine. Maybe you can stay on with the second question that then can be also answered by Leonie, by Anne Sevsik. I'm sorry if I'm not pronouncing correctly the name. Anne also says, interesting presentation, thanks. Could you provide a bit more insight into how different sectors, foundations, pension funds, specifically recognize or prioritize sustainable finance in Switzerland and Hong Kong? Which pieces resonate per segment in each geography? Sabi, maybe you want to start?
Yes, I've briefly touched on this. We've worked with Swiss foundations on a study about the investment behavior of foundations, and we see there that especially large foundations start to adopt broad sustainable investment policies, while smaller foundations often still focus on exclusion screens, maybe some products with a best-in-class approach. so much about foundations. With pension funds, we also see a strong difference between large pension funds that often have quite sophisticated sustainable investment policies, specific climate policies as well, while smaller pension funds are still in the process of developing their policies, and they often start with simple exclusions, often referring to controversial weapons. But we've seen that they now really start to move and also broaden their sustainable investment policies.
Thank you. And Leonie, from the Hong Kong perspective?
Sure, I think I very much agree with Sabine's perspective. To answer the question around, do we see a specific segment resonating in China and or Hong Kong? I think from the foundation perspective, and foundations that we've certainly engaged, maybe resources like the Asia Venture Philanthropy Network has done a fantastic amount of research into understanding foundations' appetite, specifically around impact investing, and looking at thematic areas of interest. You know, I think traditionally it probably has primarily focused around education, health, and well-being. But I think what we're also seeing is that shift to supporting around climate action. But certainly as issues become more significant and more prioritized in the market, I think that change in trajectory and foundation capital and where it's supporting is starting to change too. So I would direct you to resources like the ABPM network, specifically for foundation thematic interest areas.
Okay, thank you. It's already almost 4 p.m. here, 5 p.m. sorry, here in Hong Kong, but I would like to have the last two questions to be answered. Leonie, we can start with you by Guillaume Page. Thank you for the presentation. From your investor community in Hong Kong, where are they focusing their sustainable investment, in Hong Kong, Asia, or globally? And then the question goes on, so it says, in your view, where Hong Kong stands compared to other financial hubs in Asia, Shanghai, Tokyo, Singapore, as financial hub for sustainable investment?
Sure. So to answer the first question, I think something we mentioned earlier is that, at least from speaking from our investors, they are broadly geographically agnostic. Can't speak, you know, for the broader market, but I think we are seeing indications that we are global investors with a global mandate. Now, it does depend on the strategy or asset that we are looking at. You know, if we're looking at more direct deals and support for social enterprises, what you may find is the wealth over private or wealth owner perspective, maybe to try and work with social issues or environmental issues that are close to their heart within, you know, Hong Kong or within Asia. That's certainly something that we do see. So I think that's important to bear in mind in terms of where we have, you know, how do we stand compared to other financial hubs in Asia? That's a good question. And I think something that we are often trying to understand is how can we, you know, increase our capital allocation towards ESG. You saw some of the data that I presented earlier on, where Hong Kong only represents 0.2% of global ESG AUM for sustainable investing. So I think that gives you a bit of a snapshot of where we are as a hub, but I think that's changing. I think our capital allocation towards ESG is moving. We have obviously seen Singapore, Japan, Tokyo, with the GPIF developments help propel the market forward in other Asian jurisdictions. And I think what we're starting to see now is that similar policy ripple effect happening in Hong Kong. So I think it's only a matter of time that some of the data that we saw Hong Kong being positioned more as a laggard, that's certainly set to change, I believe, in the coming years.
Okay, thank you very much, Leonie. It's already 5:03 here in Hong Kong. I'm sure everyone is full of several commitments, or maybe in Hong Kong ready to go home. In Switzerland, the day needs still to go on. I would like really to thank Sabine and Leonie for this very interesting webinar. Also the question we have seen, there would be more to answer. Unfortunately, the time does not permit that. But thank you very much. I think it's been a very fruitful and interesting exchange. To all the participants, thank you. As mentioned, the webinar has been recorded and you can listen to it also later on the YouTube channel of Swiss Sustainable Finance. And if you have questions, comments, please do reach out to us per email. Even physical events are not that common right now, but emails work very well. So thank you very much to everyone.